Good afternoon, ladies and gentlemen, and thank you for joining us this afternoon for July's OIC monthly webinar series. My name is Matt Cashman, and I'm Principal of Investor Education at OCC, as well as an Options Industry Council instructor. And today we are going to explore the concept of volatility as it relates to options, and hopefully we're going to break down those concepts into some smaller building blocks that are just a little easier to understand and help you build up your understanding of just how volatility works with respect to options and within the options ecosystem. My name is Matt Cashman, and I started trading in 1999. Just to give you a little bit of background on myself, I started trading in 1999. I've been an options trader ever since. I got my start in Chicago trading equity and index options on the floor of the CBOE. Pretty quickly after that, I moved to London and traded interest rate options there. Eventually, after about 3 years, I moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago, also on the floor of the CBOE. Currently, I work at the OCC, helping individuals and investors to better understand both the risks and the benefits of exchange-traded options through efforts like the webinar today. Now, we always include a disclaimer to make the lawyers happy. Options are complicated investment strategies. They involve leverage and they involve risk, and they're not suitable for everyone. Any strategies that I discuss, including examples using actual securities and price data, are strictly for illustrative and educational purposes, should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance, as always, is not a guarantee of future results. What this basically means is that options are complicated and they involve leverage, and you should understand what you're doing before you start trading options. One other bit of housekeeping that we need to get out of the way: the following trademarks, logos, and service marks displayed are owned wholly by the Options Clearing Corporation, and you will see them used throughout the presentation today. Now, a little bit about the OIC. The Options Industry Council is the educational arm of our parent company, the Options Clearing Corporation, which is the largest clearing corporation of equity and index exchange traded options in the world. OIC started out as a collective in 1992 to better educate the public as to the risks and the benefits of exchange traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, which you'll see right here, optionseducation.org. It is a really fantastic resource where online you can find courses, podcasts, videos, webinars like the one you're listening to now. We are able to provide these services free of charge to the public because we are fully funded by our parent company, the OCC. Now, I work at a division of the OIC referred to as the Investor Services Desk, or the Investor Education Desk, where I sit with 3 other colleagues, 2 of which are joining us today, Ken and Roma, on the chat, and they'll be fielding some of your questions live if you'd like, and then we might be able to have some time at the end for some live Q&A, but make sure to send them your questions if you have them during the presentation today. Now, where I sit on the Investor Services Desk at the OIC, this again is a free service that we extend to the public as well. We answer email questions that you can send to us at options@theocc.com. Please feel free to send us if you have questions after the presentation is over, or at any time, really. Make sure to send us these questions at options@theocc.com. The 4 of us that sit on that desk that field those questions from that email address, together, we have over about 100 years of options trading experience amongst the 4 of us. Now, this, again, is a free service that we extend to the public as well. It's important to note we are not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do, and what we really love to do, is we love to help people with general questions about options, about optionality, and theoretical knowledge surrounding the options ecosystem. like I said, amongst the four of us that are sitting on that desk, we have over 100 years of industry experience, and we are always happy to leverage that experience to help in whatever way we can to further advance your understanding of options and how to responsibly use them in your investing on a daily basis. This is the annual options volume from the year 2000 until 2021. Now, what you will see here is obviously a giant influx of players into the marketplace and a significant explosion of interest and volume, particularly over the last 2 years. We really consider this to be the modern era of options trading. It encompasses the advent of high frequency trading. And like I said, as you can see over the last couple of years, the explosion of interest and volume in options trading has been significant. 2008 was obviously the financial crisis, which set a new record for volume traded at the time. I was trading index options on the CBOE at the time, and I remember seeing close to 4 billion contracts hit the tape at the end of the year and thinking that was a massive number. And at the time it was. 2011 then came along, which was the advent of the sovereign debt crisis. And that obviously blew those numbers out of the water, which then in 2018, OCC cleared 5.2 billion contracts. 2020, they cleared 7.52 billion contracts. In 2021, they have cleared 9.93 billion contracts at OCC. This was obviously brought about by a significant amount of market volatility due to COVID-19 and the pandemic that spread throughout the world. One thing that I think about when I look at these numbers from an educational standpoint is I think that it makes what we do at OIC and the education that we provide that much more vital to a healthy, functioning marketplace, because we want everyone who's involved in this marketplace to understand how the options that they are trading actually work. The last thing that anyone wants is for people to walk into an options marketplace without a good basis of knowledge, walk in, lose money, and say, you know, the options marketplace isn't what I thought it was, and then never come back and never trade options again. Options are obviously complex investment strategies, but what we do at OIC is that we try our best to educate people and give them the tools that they need in order to be able to make trades in a really in a knowledgeable way and be able to approach investing with options and understand the risks and the benefits that there are there. So obviously, OCC is the world's largest equity derivatives clearing organization. Like I said, 2021, OCC cleared 9.93 billion contracts, and the average daily volume was 39.4 million contracts per day. In 2022, what we are currently seeing are numbers that are going to probably be higher than these numbers. They are meeting and/or exceeding these expectations. I would expect that at the end of 2022, you're going to see somewhere north of 10 billion contracts that OCC is going to clear. And this number is probably going to be north of 40 million per day on average. So it's important that you understand how these options work, because there's a lot of them trading. So with that said, let's make sure we get right into the heart of the matter and talk about what we're going to look at today. We're going to look at historical volatility. We're going to talk about how historical volatility is different from implied volatility, what both of those concepts mean and how they interact with each other. We'll also dive into Vega as a concept as well as a metric. We'll talk about conceptually how you can think about Vega, and we'll also talk about how the metric Vega can help you to actually be able to understand how much risk you have on with your options. We will dig very, very lightly into Skew. We're not going to go very deep on Skew, but we're going to dig very, very lightly into Skew, and then we'll talk about a couple of volatility strategies that are pretty simple that you can use on a daily basis in your investing. Hopefully we'll have some time left over for some Q&A at the end. With that said, let's dig right into historical volatility. So volatility, what is it? What does it mean? How can we use it? And how can we build a framework within which we can evaluate what's going on in front of us? Volatility reflects merely the fluctuations in underlying stock price. Moves to the upside and moves to the downside are essentially the exact same as far as historical volatility, especially, is concerned. Upside and downside moves, it doesn't matter which direction you're moving. The thing that matters is the amplitude or the size of the move and over how much time it took to make that move. How many days, how many weeks, months, or how many hours? People measure it in lots of different ways, especially historical volatility. They measure it. I know people that measure it on a minute by minute basis as well as hourly basis, but you can also look at it over days, weeks, months, and longer. Now, like I said, volatility does not imply a price trend up or down. Those moves are the same regardless as far as historical volatility is concerned. The only thing that matters is how big the move was and how long it took to make it move. Now, if you think about it in this kind of crude graph terms, historical volatility can be thought about in a couple of different ways. If you were to look at both of these, let's consider these to be both stocks, the black line and the orange line. Now, both of these stocks started trading at the same price. They ended trading at the same price. And over this time period, they had significantly different paths to get to that point. Now, the black line obviously has a much more volatile path. It included so many more different price iterations that were farther away from the mean than the orange line did. But really, if you were just to look at this as a starting and an ending point, you could theoretically just look at it and say, well, they both started at the same price. They both ended at the same price. But the difference between these two is that they have significantly different historical volatility profiles. Understanding volatility gives you a window into options pricing and a framework to make decisions within that. Lots of people use this word volatility to describe the market in general. You hear people talk about, oh, it's a really volatile market. We're going to use this term in a very specific way today, in a couple of different specific ways. It's important to pay attention to how people are using it. What context is that word being used in? Because that informs what that word actually means. It can mean lots of different things. We're going to look at a couple of different ways that volatility can be used and talked about. Remember, volatility numbers tell you a story of how things have happened, especially when you're dealing with historical volatility. Without those volatility numbers, it can be really easy to misinterpret past price action and be influenced by what's happening right now in front of you. The idea behind historical vol is that it gives you a frame of reference for where things have been and how much things have moved in the past. So with that said, historical volatility is a measure of underlying volatility over a specific period of time. All it does is measure how much something has moved in the past. It can be observed, it can be quantified, and it is very importantly a backward-looking metric. If you remember one thing about historical vol, what I want you to remember is that it is backward-looking. It represents the history of price movement of whatever asset that you are looking at, be it a stock, a bond, an index, a commodity. Anything that has price history and price iterations over time, you can calculate its historical volatility. It's a statistic, it's a fact, and it is not a prediction or a forecast. Let's look at how different levels of historical volatility can really make price distributions look differently. Let's compare three different stocks: stock A, stock B, and stock C. Stock A has a 15 historical vol, B has a 25, and C has a 35 historical vol. What this means is that obviously over whatever time period that we are measuring, stock A is moving the least amount of this and stock C is moving the most amount of this time period. Now, when you have lower volatility levels from a historical vol perspective, what it yields is a higher concentration of price iterations and price settles around the mean. What that gives you is a higher amplitude of the distribution with a narrower band here. And the reason why is because what you're doing is stacking basically a bunch of all of these price iterations clustered around the mean. Maybe the stock settled 99 one day, and then 100 the next day, and then 99 half, and then 101, and then 99 half again, and then it settled 100 for 3 days in a row. You can see how all of those would be clustered around this mean. Well, as the historical volatility levels get higher and you deal with assets that are moving more and creating higher historical volatility levels, it yields a lower concentration of prices around those means. And what it does is it more evenly distributes these price iterations, and it gives you a flatter distribution. Ultimately, as volatility tends towards infinity, the distribution would tend towards a straight line. What that means is that in that situation at infinite volatility levels, every price settle becomes equally as likely on a daily basis. Consider a situation, like I said, in 2008, I was trading indexes on the floor of the CBOE. Volatility was extremely high for a very long period of time. Each day when I walked in, you could have told me that we would settle 2, 3, 5, 6 standard deviations away from the previous settle. And eventually, after I experienced enough volatility over and over and over and over again on a daily basis, I would say, it's certainly possible that we settle 6 standard deviations away, because yesterday we settled 4 standard deviations away, et cetera, et cetera. And all of those possible price outcomes start to become equally as likely. As volatility tends towards infinity, these price distributions start to look a lot more flat, eventually becoming essentially a straight line as all prices become equally as likely. So that's how historical volatility can affect these price distributions. Let's look at implied volatility as far as how it is a contributing factor, not only in its conception, but also into how it affects option prices. First, let's look at its definition. Implied volatility is a major component of option valuation. Only options have implied volatility. Stocks do not have implied volatility. The underlying stocks and assets that have, like I said, price iterations and settles have historical volatility because they have settled all of these different historical numbers over time, but they don't have implied volatility. Only options have implied volatility. It's the main input for all pricing models. It reflects a current forecasted volatility assumption with respect to the current underlying price and movement. What it is essentially is the market's best guess for the underlying stock's future volatility. It's the market essentially trying to crowdsource the idea of how much vol you can expect from this asset over the next period of time. If it's a 30-day option, it's really the implied volatility of that 30-day option is the market's best guess as to how much that stock is going to move over the next 30 days. It's a forward-looking metric. It is a forward-looking metric. Let's say that again. Historical volatility, which we just talked about. Remember I said, if you remember one thing, I want you to remember that it's a backward-looking metric. The converse is also true for implied volatility. If you remember one thing about implied volatility, I want you to remember it is forward-looking. It is a forecast from the marketplace for volatility that is theoretically going to happen in the future. Now, like I said, implied volatility represents the market's best guess as to how much vol is going to exist in the future. If you look at this, what you should really think about is the contrast of the two concepts that we just talked about. What we're dealing with here is today, previous to today, and advancing from today. So historical volatility is backward looking. It deals with what has happened in the past. Implied volatility is a forecast. This is a backward looking metric. This is a forward looking metric. Option implied volatility reflects current expectations of what the market thinks is going to happen over the next period of time. There's a couple of things about implied and historic volatility that can get a little wonky when people are trading. And a couple of those things are really concentrated in how far away implied vol can be from historical volatility levels. The answer to that question is it can be at great variance with the stock's historical vol number. Think about the way that we just described those two metrics, right? One of those metrics, historical vol, is in a sense an immutable number. It's not going to change over time because it's in the past. The last 30 days of price history are exactly that. They're set in stone, and they're the last 30 days of price history. Now, the other one is an implied number. Implied meaning that it's a prediction of future stock volatility. And if you think about what those two things are really saying, you can really start to conceptualize how far away from each other those two metrics can really be. You've got one that is just the history of price, and you've got one that is really a forecast for what's about to happen. And so those two things can be totally disparate as far as levels are concerned. What you should expect with volatility, and particularly implied volatility, is it is dynamic, and you should expect it to move around. It can move intraday, it can move intra-minute, it can move intra-second. It can happen abruptly, it can happen significantly, and it does not always require a change in the underlying stock price for the implied volatility of the options to change. Like I said, generally it's a dynamic feature of any options premium. It's a big part of what options are worth and how people value them. If you're a market maker trading options, the biggest knob that you have to turn in your arsenal from a modeling perspective is really the way that you can most quickly affect change in option prices broadly across the board, and that is implied volatility levels. And since option prices, just like any other tradable security, are kind of at the whim of supply and demand, implied vol is going to change based on those market forces on a constant dynamic basis. When I was trading options very actively, if someone came in and bought a lot of options at the time that were driving the price higher, the first thing I would really do in my toolkit is I would raise the implied volatility level until I ran into a level where someone would be willing to sell me some options back. And then after I did that, I would sort out kind of whether I should be moving things like skew, or whether I should be moving the time spread, or whether I should be moving kurtosis and the wings versus the ats. All of those are much more complex ideas that you have to take time to sort out. But the first thing that's going to move, generally speaking, is the implied volatility level, because it's a really fast way to affect a broad change in option prices across the board. Here's a couple of questions that we get all the time on the investor education desk. Will an options implied volatility return to its underlying stock's historical delivered volatility level? The answer to this is not necessarily. It's really not safe to assume it will. The reason why is what I just said, right? Option implied vol is a forecast, and option historical vol is a backward-looking metric. It delineates the history of the price. And so those two things can really pull apart from each other. Now, they are somewhat related, but they do not necessarily have to stick next to each other all the time. You will see a lot of circumstances where they are moving around in far away from each other from a metric perspective. Now, another question we get, why do I care about implied volatility? Why should I care about it? I trade prices, I trade options I trade a $3 option and I wait for it to go to $4. Well, that's fine. But what you really need to understand is the forces that are at work that are contributing to the actual valuation of that option are very important. And like I said, implied volatility is one of those giant forces that are moving prices around. And so if you're concerned about prices, then you need to be concerned about implied volatility levels. Let's look at how it affects prices a little bit more specifically. If you were to keep everything constant, now obviously this is saying a lot. There's a lot of forces that are moving around in the options market on a constant basis. If you were to keep everything constant, the one thing that I can guarantee from a modeling perspective, prices in options are going to move up if everything else is constant and you move implied volatility up. If you keep everything constant and the only thing you change is implied volatility, both call and put prices will increase. Conversely, if you keep everything else constant and you move implied volatility down, both call and put prices are going to decrease. That is something you can rely on. It is a modeling fact. It's not going to change. That's how implied volatility as a metric that gets pumped into these options works. Now, keep in mind, you are keeping everything else constant. How many times do you see a marketplace where everything remains constant and only one knob turns? Not that often. But what this is really meant to, the concept that this is really meant to get stuck in your head is that vol is a huge part of how much options are priced. And so you really need to pay attention to it regardless of whether or not you're just trading on a price basis or whether you're trading significantly more complicated strategies where you're hedging them and creating vol levels and trading a vol dispersion book or whatever, right? That involves much more sophisticated and much more complex strategies as far as volatility is concerned. A lot of people ask, okay, that's great. Now I know that vol and implied volatility levels are moving option prices. Well, how much can I expect them to move? When implied volatility moves, how much can I expect them to move? Let's talk about Vega as a concept and as a metric to help you understand how much these options are moving based on just how much the implied volatility is moving. First and foremost, let's define Vega. Vega is one of the Greeks. It's one of the first order Greeks. There's 5 of them. Vega is a measure of an option value's sensitivity to volatility. What that means is it's how much you can expect your option to move in price with a 1% change in implied volatility. That means if the vol goes from 20 to 21, you should expect your option to move from a modeling perspective its commensurate amount of Vega. Now, Vega is expressed in decimal form, like it says here. In this case, 0.08 would be, we would say this has 8, we would say it's an option that has 8 cents of Vega. It represents a cash amount per option. Now, again, all other pricing factors remaining constant. Keep in mind one other thing about Vega. Vega is the greatest in at-the-money options and in long-term options. Let's talk a little bit about how you can really take this number and think about it and conceptualize it from an everyday perspective. Let's say I'm trading an option that has 8 cents of Vega, and the vol goes from 20 up to 21. It moves 1% up. I'm expecting that option to move 8 cents. So let's say the option's worth $2. If the vol goes from 20 to 21 and nothing else moves, I should expect that option to be worth 2.08 because of the amount of Vega that's in the option and how much the actual implied volatility level moved. Both calls and puts have positive Vega amounts. This is really important. Calls and puts both have positive Vega amounts. You can create a positive and or a negative Vega position by what you do with the options. If you buy a bunch of options and all you do is buy options, no matter what you're going to have is an options book that is long Vega. Now, it's not long Vega just because the options themselves have positive Vega. It's long Vega because you bought them. And thus your exposure is that you are long Vega. If, on the other hand, you sell options constantly and all you do is sell options, you are going to have a short Vega position. You are going to be exposed on the short side of Vega. And so the reason why those positions are being created is not because the option has short Vega or long Vega. It's because what you have done to the option, you selling that option has created a short Vega position, or you buying that option has created a long Vega position. It's very important to understand that. Implied volatility levels, again, going up will move option values up by the Vega amount, and implied volatility levels going down will move Vega amounts down by the Vega amount if you keep everything else constant from a modeling perspective. Let's look at a couple of different examples of how Vega can work in a real world environment and how you might see this play out in front of you. One of them would be Vega going up, and one of them would be Vega going down. So in this case, let's say an investor buys a D50 call for $3. The stock is trading 50, and it has 60 days until expiration. So you're buying the at-the-money call, and you're paying $3 for it. The next day you come in and stock XYZ has moved a bunch. It's fluctuated all over the place. But at the end of the day, it trades $50 again and it closes there. However, when you look at the option that you bought yesterday, that you paid $3 for, it's trading $3.40. Well, what has happened here? Generally speaking, you can look at it in a kind of forensic way and go back and look at what actually has happened. If all of the other factors have stayed the same, the underlying price has definitely stayed the same. The strike price is the same. You actually have one less day to expiration, so that has changed. That's changed slightly. But as we'll see later, one less day of days to expiration generally makes an option go down in value, not up in value. So from a forensic perspective, you look at it and you say, what could have happened here? Well, there's only really a couple of different ways that you can explain it. Like I said previously, the easiest way to broadly affect change in option valuations from a market maker's perspective is just to turn that implied volatility knob up and down. And in this case, what has happened is the implied volatility level of that D50 call has increased. In this case, also implied volatility level was 35 when you bought it. It's 40 the next day. And what you have if you're long that option is you have unrealized profit. Just like anything else. If you bought a stock and it went from $30 to $35 the next day and you hadn't sold it yet, you would have unrealized profit. Well, you have the same thing in the option in this case, and the only reason why is because the implied volatility level has gone up. And so this is a situation in which when people ask, well, I just trade options and I don't care about the implied volatility level, this would be a certain situation where you're really going to want to know what the implied volatility level is and why the option is moving in the way that it's moving. Because there's nothing else here that can actually explain why the option went from $3 to $3.40. The stock traded in the same spot that it traded yesterday, doesn't have any different delta. The days to expiration are roughly the same. It's something that really affects how these options are priced, and you need to understand it in this case. Now, again, if you had written this call or if you had sold this call, then you might not be so happy about it. If you were long it and you came in and it was trading $3.40 after you paid $3 the day before and the stock was in the same place, you'd probably be pretty psyched. If you had sold it, you probably wouldn't be quite as happy about it. That is a situation in which a call might go up in value because of the implied volatility level moving up, stock staying in the same place. Let's look at a slightly different example of how implied volatility can play out in a different direction. So the way this is setting up, we have a pre-earnings situation in a stock. It's trading $100 and there's 13 days to expiration. The implied volatility level is 50. With the stock trading 100, we're trading the 105 call, slightly out of the money. It has a 30 delta. These are the rest of its commensurate Greeks, and it's worth $1.85. Now, let's say you sold this call. And let's also say that earnings have come out, and we have a slightly different situation here as far as prices are concerned. Post earnings, the stock is trading 105. So the stock's up $5. This is 7 days later. If you look, there's days to expiration were 13 here. There's 6 here. So 7 days have elapsed. It's post earnings. The stock has risen $5. And the implied volatility level is now 30, whereas it used to be 50. Take a look at the difference, not only in value, but in the Greeks of these two options. They're the same option. However, the value, 185 pre-earnings with 13 days to expiration, $1.20 post-earnings with the stock up 105, up $5 trading 105. You only have 6 days left. What's the biggest mover here? Well, the value of the option obviously moved significantly. The delta moved significantly. But the implied vol got cut almost in half. Even with a $5 increase in the share price, these calls lost value due to time decay and decreasing implied volatility levels. Again, days to expiration, 13 versus 6. You're losing 7 days. So you have 7 days of theta coming out. But this implied volatility level is the most instructive of all of these metrics as far as what's happened here. From a forensic perspective, again, I would look at this and I would say, well, you definitely have days coming out and the commensurate amount of theta that comes out with it, right? This had a 15 cents of theta per day. So 7 days later, a significant amount of that is theta, but some of that has been counteracted by the delta of this option going up in value. Really, from a forensic perspective, you would look at it and say the implied vol of this option is cut almost in half. And even with the stock going up, they lost value. And that's the reason why, is because the implied vol got hit so hard post earnings. This is a very real world scenario where this kind of stuff happens all the time. Like I said, implied volatility, it is a very dynamic feature of these options and can affect prices significantly. If you were to tell me that the stock went up $5 over 7 days and didn't tell me that the implied vol did this, I would think that these calls probably did pretty well from a long perspective. However, if you were to tell me that the implied vol went from 50 to 30, I would say you're probably not going to do very well being long those calls, which is the case here. So those are two examples of how implied volatility and the movement of implied volatility really, really affects option prices and how they are calculated on a daily basis, and how implied vol, right? It's a forecast of what's happening in the future, but it's moving all the time. And so you need to pay attention to it when you're trading and understand what levels of implied volatility you're trading, because it can make a big difference in how much options are worth. Now, another way that implied vol can move around is with a concept called skew. Skew is something that a lot of people get a little confused by because it's talked about in very kind of nebulous ways a lot of times and doesn't make a lot of sense with how people talk about it. Skew is essentially the difference between volatility levels of at-the-money options and the volatility levels of out-of-the-money calls and out-of-the-money puts. A lot of people look at 25 delta options as those out-of-the-money options as ways to measure kind of a generic skew option. The 25 delta call and the 25 delta put oftentimes are put together as what's called a risk reversal or a combo. And people generally use those areas of options delta-wise to pick out implied volatility levels and understand where the skew is relative to the implied volatility of the at-the-money option on a day-to-day, minute-by-minute, year-to-year basis. Skew is something that can be measured, can be quantified, and it can also be discussed in lots of different ways. It's a little bit like that term volatility. It gets thrown around all the time. It matters how people are using the terminology, and it matters how people are measuring the actual concept in order to be able to discuss it adequately. You need to understand, well, if you're just talking about skew, skew can mean lots of different things. And so it's important to understand how people are using the word in order to talk about it. Ultimately, skew is a function of supply and demand, just like anything else, just like implied volatility levels and option prices and stock prices. It can be quite dynamic, just like options can be and implied volatility levels, and it can be very unpredictable. It can move in significant ways in a very unpredictable way. Here's an interesting difference as far as skew is concerned. Equities and indexes tend to have a skew that has higher out-of-the-money puts than out-of-the-money calls, meaning the at-the-money option, generally speaking, on a skew curve for that month is generally thought of as the lowest point on the skew curve for implied volatility levels. I'll show you what that looks like in a moment. However, the actual puts in an equity and an index skew model are generally higher than the at-the-money calls. And the out-of-the-money calls can sometimes be lower, actually, than the at-the-money calls. They can also be a little bit higher, but they're generally not as high as the puts are. The commensurate 25 delta put generally has a higher skew, a higher implied vol because of skew than the commensurate 25 delta call does. The reason why this exists is because equities and indexes, from a price history standpoint, over a very long period of time, tend to have explosive moves to the downside. And they tend to stair step up in price to the upside. You've heard the saying, equities take the stairs up and the elevator down in price. That's something that people say for a reason. They say it because the price history has fleshed that out. The price history of equities and indexes is that they stair step up over time, but when they have extremely volatile moves, generally speaking, those volatile moves are to the downside, not to the upside. And so what that has done to option skew and implied volatility of those options is that it's made the puts a little bit more expensive from an implied volatility standpoint than the calls are. And the reason why is because skew is a way that people essentially kind of telegraph the idea that the option is worth a little bit more on the put side than it is on the call side in the equity and index world because of those price iterations over time. Now, commodities have generally the opposite of that. They generally have demand skew. They have higher volatility levels for the out-of-the-money calls than the out-of-the-money puts. Also generally dictated by long-term price history for commodities. If you think about how commodities work, commodities have those explosive moves to the upside. They are demand skew products, meaning they have really explosive moves when people can't get their hands on them. They need the physical commodity. A lot of people need the actual physical commodity to do business. If you're an oil refiner, you need the actual oil in order to run your business. And if you can't get your hands on the oil and there's 7 other people around you that are also oil refiners, there's going to be a race to buy oil because no one can do their business without it. Thus, these commodities have explosive moves to the upside, and that is represented many times in the way that the options are priced from a skew perspective. Let's look at how skew looks in practice in that case. So this is the strike prices. Let's consider this as an equity skew, essentially. It's a very generic, theoretical equity skew. These are the strike prices on the left-hand side, 5 up to 105. And these are the commensurate implied volatility levels of those strikes. Each strike has its own implied volatility level. What you get when you graph this is what looks like a very typical equity or index skew. Now, remember what I said before, where the at-the-money option generally comes out as the lowest option on the skew curve. The reason why that is because of the way that those price distributions looked when we looked at them earlier, the 15, 25, and 35 historical vol, right? Those create these price distributions that have a lot of prices centered around the mean. The volatility skew is essentially just that price distribution flipped upside down, is the way that I like to think about it. Now, volatility skew in these terms is basically a way for the marketplace to telegraph what they think these options are worth from a volatility perspective. A lot of people will look at this and say, well, the options are priced in a way that with the stock trading 50 or 55, it's trading on a 15 vol, an at the money 15 vol. But what the marketplace is saying is if the price of the stock goes down to 20, let's say, the marketplace is telegraphing that the implied volatility of the at the money option should be 28 down here. Well, that might be the case. It might not be the case. Skew, just like implied volatility, is a forward-looking metric because it is a volatility in and of itself. Each strike has its own vol and is created by the prices that are trading on that strike on a minute-by-minute basis. If someone came in and sold a ton of puts in this equity, this generic equity, you might see this skew come down and trade like this down here. Skew changes all the time. And commensurately, if someone came in and bought a bunch of calls, you could certainly see the skew tick up like this and be much more of a smile. Skew is dynamic, just like implied vol is dynamic. And the reason why is because skew itself is made up of all of the implied vols of all of those strikes. Let's move on and talk about some volatility strategies, some really simple volatility strategies that you can use on a daily basis. The long straddle and the long strangle are the two that we're going to really dig into here. The long straddle incorporates buying one of the 40-day, 45-day calls and one of the 45-day 87.5 puts in this case. The call's trading 215, the put's trading 185. A straddle is buying both the call and the put on the same strike. You're buying one of each. And it trades as a single price, the straddle normally does. And it trades as a commensurate 215 and 185 together. If you were to buy both of those options, your net debit's going to be $4 for this straddle. Now, what does a straddle look like from a P&L perspective? So the straddle, when you go straight to its expiration, this is really an expiration graph of what it looks like. When you buy a long straddle and you pay $4 for it, you are essentially creating a P&L graph that looks like a giant V. You have unlimited upside and downside potential as far as profit is concerned, and you have limited downside. Your max loss is what you paid for it. As long as you are not trading this in a complicated way where you're trading other options against it, or you're trading stock against it, or you're doing any of these other things, if you just buy a straddle and don't do anything else against it, the most you can lose is what you paid for it. Now, in this case, it's a $4 straddle. Options are priced in per share dollar increments. And so when you see a straddle that costs $4, equity options in general in the United States control the right to control 100 shares of stock. And because options are priced in per share dollar terms, in order to do the notional math for what this straddle is actually worth, you need to multiply this by 100. And so what you're really buying when you buy this is $400 worth of premium per one lot. What that does is it gives you break evens of $4 in either direction for the stock. You bought an 87.5 straddle. If the stock moves more than $4 to the downside, 83.5 is your downside break even, or more than $4 to the upside, 91.5 is your upside break even. To the downside, your put is going to kick in and start to become worth more than what you paid for the entire strategy. Down here, it'll start to kick in and you'll be able to participate on the downside. And to the upside, your call will kick in and start to participate on the rally. Let's look at the strangle. It's very similar. It's basically the same kind of options. It's the 45-day 90 call and the 45-day 85 put. The big difference between the straddle and the strangle is that you have essentially, instead of buying the exact same strike, what you're buying is the slightly out of the money call, the slightly out of the money put. And what it does from a P&L perspective, obviously the strangle costs less than the straddle here, right? The call costs $1.20, the put costs $1.30. The entire strategy costs you $2.50. Don't forget to do that notional math, multiply it by 100. That's going to cost you $250 in notional premium. But from an expiration P&L standpoint, what you're looking at is essentially the same graph, but you've moved this and you've created, instead of it having a V to it, it has this flat spot here. Now, why does that flat spot exist? It exists because this is the distance between those two strikes, 90 and 85. Whereas previously with the straddle, you were trading the 87.5, both call and put. And so you got a P&L graph that looked like a straight V. This looks like a V, except it has this distance between the two strikes. The same principles apply to this. You have unlimited upside potential to both sides, and you have a max loss. Again, if you're not trading anything against it, you have a max loss of what you paid for it, which is $2.50. So to the downside, your break even is going to be 82.5. That's your put strike minus what you paid for it. And to the upside, your break even is going to be 92.5, which is your call strike plus what you paid for it. So outside of 92.5 and 82.5, this strangle starts to make money. Straddles versus strangles. Let's talk about what they look like from a theoretical standpoint. Straddles have higher costs and lower leverage because of that. Like we said, the break-even points are a little closer together because of that very deep V function that it looks like on a P&L standpoint. These are obviously what those graphs look like, long straddles. You can also sell straddles. If you sell the straddle, it is important to understand that you have unlimited risk and limited profit, whereas if you're long straddles, you have unlimited profit and limited risk. Very important to understand the difference between those two things. Strangles obviously have lower costs, like we just talked about, but higher leverage because of their lower costs. And their break-even points are farther apart because of the fact that you've distanced that flat part of that P&L curve by the distance between those two strikes. Long straddles obviously look like this from a P&L perspective generally. You can also sell strangles, and they look like this, just flipped upside down. Again, very important. If you are selling strangles, you have unlimited risk and limited reward. If you're long strangles, you have limited risk and unlimited reward. When you're long options, time decay can be very painful. And without underlying movement, the theta of these options can start to eat into the premium over time if you don't get the commensurate amount of movement that you need in order to counteract those forces. The other thing that you need to keep an eye on if you're trading straddles and strangles, what is the implied volatility level that you are buying and or selling? And after you buy and or sell it, what is the implied volatility level that is being implied by the price of the straddle at this point in time? If you were to fast forward your clock 5 days forward, what would the implied volatility of a $5 straddle be 5 days from now? A lot of people who are trading volatility think about it in those terms because they want to know and be able to kind of build that framework in their mind as to how those implied volatility levels are moving and what they mean from what does a $5 straddle mean? If it means that I'm trading a 25 vol, that's one thing. If it means I'm trading a 75 vol, that's a completely different trade altogether. And so you need to be able to understand how the implied vol level relates to the price of the option, and then also how you can incorporate those historical volatility levels that you can look at from a price history standpoint to give you a frame of reference as to whether or not those implied volatility levels that you're seeing are what you want to be trading. A lot of people trade these options and don't understand what the implied volatility levels are. It says a lot about your trade based on what your implied volatility level is that you're trading. It's the equivalent of paying $100 for a stock versus paying $25 for the same stock. Those are two completely different trades, and it's important that you understand what it means when you're making those trades. Now, in volatile markets, options can be really very useful investment tools. They can provide you leverage, they can provide you income, risk mitigation, profit potential, but it's very important that you understand the risk profile of the strategies you're creating and how things like implied volatility and skew factor into those strategies. Each strategy that you trade carries with it its own risk profile and a commensurate amount of profit potential. If you understand how they work from a theoretical perspective, you will be well prepared to be able to utilize these strategies and understand when your portfolio calls for them, and to know which one is best for not only you, but also best for the circumstance that you're looking at, because it changes on a minute-by-minute and day-to-day basis. I hope that some of the information we gave you today can help you along that road. Please feel free to reach out with any questions you may have. Send us email questions at options@theocc.com. Make sure to check out optionseducation.org, our website, for all of those educational resources that I said. I really appreciate the time today. I hope we have time for some Q&A. Ken, what do you think? We got 5 or 10 minutes?
Hey, Matt, can you hear me?
I can.
Hey, great presentation. A lot of really good, useful information. Yeah, we did get some really interesting questions. So with the time remaining, why don't we address a couple of these? So somebody asked about a butterfly. So essentially, in a butterfly, for those who don't know, you're essentially, if it's a strict call butterfly, you're basically, it's 4 different options. You typically sell 2 at-the-money calls. In the case of a call butterfly, you buy an out-of-the-money call and an out-of-the-money, I'm sorry, an in-the-money call and an out-of-the-money call against it. That's a typical butterfly. And, people will do these, it's a way to take advantage of high implied volatility while mitigating your risk. So the question was, in a butterfly, where I'm contract neutral, delta neutral, how does Vega affect me, Matt?
That's really interesting. That's a good question. Vega affects you when you are contract neutral and delta neutral in that situation. You have to think about Vega in terms of how much Vega is in the options that you're long versus how much Vega is in the options you're short. Right. And how the Vega is going to move those options independently, because it will move those options slightly differently depending on how much Vega those options have. Now, if you're long the out-of-the-money options and short the at-the-money options, you're short a lot more premium, generally speaking, than you're long. And Correct. So there's a couple of different ways that you need to think about this. Generally speaking, in equities, when vol levels, implied vol levels come down, a lot of times what will happen is the implied vol level of the straddle, the at-the-money options, will move down faster than the out-of-the-money options. And the reason why that happens, if you think about it from an intrinsic versus an extrinsic option premium standpoint, it's a lot easier to take value out of a $5 option than it is to take value out of an option that's worth 25 cents. If you're moving a $5 option down, you can move it down by 30, 40 cents, and it doesn't really affect the option quite as much as if you were to move a 50-cent option by 30 or 40 cents. And so Right. When you think about what happens with vol when you're trading butterflies, is a lot of times those at-the-money options will move a lot more as vol comes down, because the out-of-the-money options stay firm relative to the at-the-money options, because they're easier to move. The at-the-money options are, basically, from an extrinsic premium standpoint.
Right. And you could actually argue in the fact of a case of a butterfly, even though you're delta neutral, contract neutral, you're probably going to have, if you're short those at-the-money options, you're probably going to have a net short Vega position. So in that case, obviously, a rise in implied volatility would you'd have a slight, it'd slightly go against you, and a decrease in implied volatility would be beneficial for you. So kind of along those lines, I think we have time for one last question. Somebody was asking about the Greeks. Like, they understand the Greeks, how the Greeks, the different Greeks, delta, gamma, Vega, theta, and rho. But out of all those Greeks, is there a Greek that you would consider more impactful than the others? And I know what my answer is, but I'm going to throw it to you.
I like that you have an answer for yourself already. My answer, I'm going to give you a twofold answer to this. And the reason why is because I think it's kind of a slightly nuanced question. I think if you are trading short-term options, and I term short-term options as like 30 days or less, I think your number one thing that you should be looking at is gamma and kind of theta, like what those options. And the reason why is because as you get into the shorter term options, that's where most of that kind of embedded change exists within those options. They're very gamma rich, they're very theta rich. And so that's what I would pay attention to if I'm trading a portfolio that has 30-day options or shorter duration than that. If you're getting into 60, 90, 120-day options, like close to a year out, I think personally that like at the top of your list should probably be Vega, because those options have more Vega in them than they have gamma or theta. And you need to be looking at that, because that's probably going to be the biggest thing that's going to move your P&L out there in those options. So that's what I would say.
And
what's your answer?
And that's you said it. You took the words right out of my mouth. So nice job. I mean, I would just add that Vega also, when you have a Vega heavy position, and anytime you're long or short options, you're going to have a Vega position, whether you're near term or longer term. But longer term, your Vega numbers are going to be bigger. Okay, they're more Vega sensitive. So when volatility moves, typically, Vega is your option sensitivity to a 1% change in implied volatility. But as we saw earlier in this year during the financial crisis, when COVID hit, volatility moves in magnitudes of 5%, 10%, 50% in some cases, depending on, some of these meme stocks that we saw that went parabolic. So volatility, if you're on the wrong side of volatility, it can be very painful. And if you're sitting on an options position, you don't understand why you're making money or why you're losing money, invariably the answer lies in changes in implied volatility. So
I would agree with that wholeheartedly. And as you get farther out on the duration curve, you're going to have a position that just intrinsically has a lot more sensitivity to implied vol moves. You could move vol from 20 to 50, and you could have a 2-day option that doesn't move in price terms. But if you move vol from 20 to 50 on a 100-day option, it's going to move a significant amount in price terms because of the difference in Vega. That's the big difference, right?
Right. So anyway, I think we're out of time, so I'll let you finish up, but great presentation.
Yeah, I appreciate it. I really appreciate everyone joining us today. Make sure that you send us those questions that you have, and check out optionseducation.org. You can reach us at options@theocc.com. Like I said, Ken is one of my colleagues that sits on the desk, as well as Roma and another guy named Mark. Amongst the four of us, we have 100 years of options trading experience, and we love answering questions and being able to leverage our experience to help you learn more and use options responsibly on a daily basis. So thanks a lot for joining us, and we'll see you next month.